Welcome, everyone, to episode 13 of Just a Game. We have a very different kind of episode for you guys. We are going to be talking about the bill that just passed today, which is the Beautiful Bill Act. I'm going to pass it over to Jordan to explain what they've just added. It just got voted through the House. So, for those of you who don't know what's actually happening, Jordan, go ahead, explain.
Sure. So I'm going to start with this is not financial advice, and I'm not your accountant, but go get some professional help. But I have an opinion about, or I've read through some of it, and I'll just deliver sort of my own expectations for how this works. So first, I'm going to start by actually reading the document. If you go to Congress.gov, you can find the document, and if you can actually search the document, using Control F wager, and you can get to this yourself. But I'm just going to read through this very quickly so that you get a good understanding of what we're talking about. And it's very brief, so just bear with me. So the section is called Extension and Modification of Limitation on Wagering Losses. Okay, Part A, in general, Section 165 is amended by striking subsection D and inserting the following. So we're going to insert this amendment essentially to some previous legislation. So D, wagering losses. In general, for purposes of losses from wagering transactions, the amount allowed as a deduction for any taxable year, A, shall be equal to 90% of the amount of such losses during the taxable year. So you're not going to be able to write off 100% of your losses, the losses during the year. You'll only be able to write off 90% of the losses against whatever gains you have. So that's Part A. Part B, shall be allowed only to the extent of the gains from such transactions during such taxable year. So you can't carry forward your losses. You can't lose in 2025 and then use those losses to offset whatever you make in 2026. Okay, you can only use losses to the extent of the gains from such transactions during such taxable year. That really sucks, which is sort of, it is what it is. But I think by way of example, we don't have to read through the rest of it. Yeah, the rest of it's, you can read it if you want to, but that's the meat and potatoes of what we care about. Okay, so I'm going to continue now, sort of by way of example of how this might affect an average guy who's playing something that's not even poker. You don't have to be playing poker. You could be playing blackjack or something. Okay, so let's say you have a $10,000 roll, and the bankroll doesn't matter, but it's a realistic bankroll for the size of the bets that we're talking about. So it helps to put this mathematics inside of context, right? So we've got a 10K bankroll. We go to the casino. Maybe we're playing blackjack or something. We make $100 bets. Okay, so we're wagering $100 a pop. Okay, the number of bets we make across the entire year, but this could be a 2-week trip to Vegas, right? The number of bets we're going to make is 1,000. So we're going to make 1,000 bets. It's $100 a bet. So we're going to wager $100,000, which is simple math. It's 1,000 bets times $100, or $100,000 that we have wagered. We're going to have $110,000 in cash. So we had a good run. We didn't lose money. We have a $10,000 gain, right? Or $10,000 of taxable income from the perspective from the perspective of the normal person. When they're gambling, they think they made $10,000 and they think that they owe tax on $10,000 of income. Okay, but what's going to happen is you can only deduct 90% of the amount that you wager and lose. So if you have wagered $100,000, you're only going to be able to deduct 90% of that against your $110,000 in cashes. So you have $110,000 in cashes minus 90%, minus $90,000, as opposed to $110,000 minus $100,000. So again, instead of an income of $10,000, which is the real income, you'll have a taxable income of $20,000. Again, all that is it's 90% of 100, which is 90. Okay, and minus our gain of 110. So we have a $20,000 taxable income. The typical tax rate in the U.S. for gambling, and on average, based on my understanding of the U.S. tax code, again, I'm not an accountant. This is not professional advice. Go get some. Is that 25% is a pretty good number to use. So you have a $20,000 taxable income, and the tax that you owe now is $5,000. Okay. Now that sucks because you had an income of $10,000. So against an income of $10,000, normally you would have paid $2,500 in tax, and now you've got to pay $5K in tax. So it's twice as expensive. So That is example number 1, and that sucks. Okay, we're going to move on to example number 2. We got, again, 10K bankroll. We're making the same $100 bets. We make 1,000 bets. It's all the same stuff. We wager $100,000 across all of the bets. We cash for $100,000. So we get all of our money back. We break even. Okay, so on a net basis, we did not generate any profit or any, in our perspective, in the minds of like the average citizen, right? They didn't make any taxable income, except that they could only deduct 90% of their losses from all of the sessions that they played. And so that's going to result in 90% of $100,000 wagered, which is $90,000, offset against $100,000 in cashes, or a taxable income of $10,000, even though you didn't make any fucking money. You didn't make any money, but you're gonna have a taxable income, as I understand. Again, this is just my understanding. If I'm wrong, like, you can correct me. That's great, right? But you're gonna have a taxable income of $10,000, and then that's gonna result in tax owed of $2,500. So, in spite of the fact that there is no corresponding income, you have now created a liability for yourself of $2,500. And again, you can pull this off. You could do this without playing poker. You could do this like playing blackjack. You could do this playing slots. Like, you can make these wagers betting sports, right? You don't need to make these wagers as a poker player. I know most of my audiences are people who play poker, right? Most of you guys watching this are poker players. I'm aware of that. But I think that it's helpful to put it in the context of other games, just so that you don't start getting into like stupid arguments about like, well, what if the games get softer? And it's like, this is terrible. Like, this is terrible, and I want to avoid that discussion. So I'm using games that like blackjack as a better example, I think, for the purposes of this discussion. Let's look at example number 3. So example number 3, we have a $10,000 bankroll. We do all the same things. We wager $100 a pop, 1,000 bets, $100,000 we wager, except this time we lose. So now we have $95,000 in cashes instead of like, a break even or a profit. We have $95,000 in cashes. So in our opinion, we went to the casino, we lost 5 G's, right? You go to the casino and you wager 100 grand and you get $95,000 back. You lost $5,000. You don't have any income. So you go home and you don't pay any tax. That's the way we're all programmed, right? Except now you can only deduct 90% of your losses. So you have 95,000 in cashes. You deduct 90% of your amount wagered, the losses, whatever, right? So 95,000 in cashes minus 90,000 in losses is a taxable income of $5,000. What? I lost money. How do I have a taxable income of $5,000? 25% of that $5,000 would be a taxable income of $1,250. Okay. Again, that's going to just be like, you're a losing player at the casino, and if this is your losing year at the casino, and you're like a minus 5% winner, you're screwed. You have a tax bill, right? Like, this is ridiculous. Now, like, it's totally possible that there are other tax laws that like mitigate this, right? Like, I don't know the whole U.S. tax code, right? I don't know it at all. I'm not a U.S. tax lawyer, so I don't have a great opinion about this. Like, I'm not super educated about this. However, just reading the legislation as it works, this is the way that I understand it, just having read it very kind of like superficially, okay? So the way I'm reading it, like, this is a huge problem. Again, it's possible that there's something that says, like, in such a, like, just a basic tax law that says, like, in such a year where, like, a gambler makes, no income, he pays no tax. Like, that could be a clause somewhere, somewhere else, completely unrelated to this bill. And if it does, you don't have a tax bill for this, and like, you're fine. But again, just reading this small piece of legislation, this is my understanding of how it works, right? Now we'll go to the final example, which is, you're a high roller. You've got not even a high roller. You're just like a poker player. I mean, I work with lots of poker players that are not high rollers that have 50K bankrolls. Okay. That's like, when you say 50K bankroll for a poker player, it's probably his whole life roll in a lot of cases. Like, their life roll is their bankroll. They're synonymous for a lot of people, right? So you've got a 50K bankroll. You're wagering $500 a pop. You make 2,000 bets, so you make more bets. So you wagered $1 million, which is just, again, 2,000 times 500. You wagered $1 million. You had total cashes, so you did very well. You had total cashes of 1.1 million, and you have an income of $100,000. Now, that is pretty good. I mean, if you have a $100,000 income, like, that's what a lot of poker players, like, that's a decent, you did a decent job, right? Like, you didn't do a bad job. You got $100,000 out of the thing. Like, it's pretty good. And you would expect, if you have a $100,000 job, you pay maybe 25%, you pay 25K in tax, fine. But the IRS, as I understand it, again, this is just my understanding. As I understand it, the IRS is going to treat you as though you had a taxable income of $200,000, which, again, that's because you take the 1.1 million in cashes minus 90% of $1 million, which is $900,000. So 1.1 million minus 900,000 is 200,000. So that's your taxable income now. And then you're going to owe approximately, probably around 25% of that for the most part. And that's going to be a $50,000 tax bill on $100,000 of income. They're going to take half your money. So again, in this case, they doubled your tax bill. So, those are just 4 examples of how this might work. Again, this is just my opinion, having read through it and looked at it, and then just plugged some numbers into a spreadsheet. I didn't do anything else. I didn't consult any tax professionals in the making of this video. So if something's wrong, I look forward to you correcting me in the comments. It's totally fine. But yeah, this is my best guess at how this might look for people. And it doesn't, I think that I've seen some language in other places where, even though I didn't consult a tax professional, I have seen some other commentary on some of this. And I think that commentary was mostly wrong. If you have because, and when I say mostly wrong, I mean there are some people that say if you have a 10% ROI or less, now you can't win. And I don't think that that's how it works. Because if you think about this, just using an extreme example. So we think about this from, let's say they say that you can only deduct 90% of your losses from the total amount that you win at the end of the year, which is what they're doing, right? So let's say that we just hold that constant, right? And we say we're going to tax you on that. It's okay, fine. What's the tax rate? 0. The tax rate is 0%. Okay, fine. Then nothing changes, right? So if it doesn't matter what they tax you on if your tax rate is 0, right? So you can tax me on anything you want. If the tax rate is 0, I pay nothing at the end of the year. Everybody, that's common knowledge, right? So any calculation that you're going to do that looks at this has to look at the actual effective tax rate that you're going to pay. And this is better or worse in proportion to the tax rate, right? So at really low tax rates, this is less significant. And at really high tax rates, this is more significant. Obviously, my understanding of the U.S. tax code is still that it's progressive to at least to some degree, right? So the more money you make, the bigger the percentages that you're going to ultimately pay in tax. And the higher the percentage you're going to ultimately pay in tax, the more painful this is going to end up being. We obviously looked at, a relatively low tax rate of 25%. We also looked at relatively modest income numbers. But if we used much higher tax rates, this would look a lot worse, right? So this is, again, we just made all the assumptions around a 25% tax rate. I think it's a pretty reasonable way to look at it based on my limited understanding of the bill and the fact that I'm a degenerate gambler and not to be trusted at all. So, yeah, I mean, I guess mostly what I have to say. Jake, do you have anything else?
Yeah, I mean, I think it's important for people to know, because I've seen some chatter online and amongst the team as well, where so obviously this doesn't come into effect until 26.
Oh,
so
yes, that's very important.
Yeah,
that's
very important to know.
Yeah. Yeah, I didn't read that part when I read over the document, but yes, this does not. It's stated in the. If I go back and pull the legislation back up, there's Part B, which I should have read. This is actually really important. I should have read this part. The effective date: the amendment made by this section shall apply to taxable years beginning after December 31st, 2025. So this applies to taxable years beginning in January of 2026. So it does not apply at all to this year. And so there's no stress as it applies to this year. You don't have to worry about it. And I also personally take the opinion that this probably won't hold. I think that the 90% thing is probably going to get over a long period of time. Again, I'm not saying that it doesn't hold for a year or for 2 years, but I think that I think it's really bad for the entire gambling industry to have break-even players have tax liabilities. Or to have someone lose money gambling in a given year and then subsequently end up with a tax liability. That seems absolutely insane to me. So I don't think that that's going to be how this works in the end. When it's all said and done and it's lingered for a while, I don't think that that's going to be what happens. But for now, again, that's my understanding of it. So yeah, you don't have to like freak out about this immediately, right? It doesn't apply until next year. And I do think that this is the thing that might stick for a longer period of time is Part B, which I'll reread it, shall be allowed only to the extent of the gains from such transactions during such a taxable year, right? So the fact that you can't carry forward losses, again, at least that's my understanding, really sucks for tournament players, right? So if you're a tournament poker player and you lose $100,000 in year one and then you make $100,000 in year two, across 2 years you made $0. But you're going to have, because you can't carry forward your losses, you're going to have that 25% tax liability from year two. So you would owe, if we just simplify this, you're going to owe, if we say that your taxable income is so let's say you made $100,000 in year two. They're going to say your taxable income under a lot of different scenarios, depends on exactly how much you wagered and things like that, right? But if we keep our example from earlier content, they're going to say that your taxable income is $200,000. You wagered, you actually profited $100,000. They're going to say your taxable income is $200,000, and the tax rate, if it's 25%, you're going to owe 25% on $200,000 of taxable income, which is $50,000. And across 2 years, you actually made no money. Across 2 years, your net profit was zero. You lost $100,000 in year one. You made $100,000 in year two. Your net profit across 2 years is zero. But because you can't carry forward your losses, and because you can only deduct 90% of your losses in year two, you will end up owing $50,000 in tax, as opposed to like zero, where you just cancel out this year with last year's losses, right? So that's very consequential, and it means that when you run a gambling operation, like any kind of gambling operation, you have to make sure that it's profitable by year end, which basically eliminates certain forms of gambling. Like if you're like a professional poker player who like just plays live stops, like just plays like massive live tournaments, like big field live tournaments, that's all you grind. I don't think that works anymore because you can't carry forward your losses from years like if you have 2 years of losses and then you have like a $2.5 million gain in year three, right, to offset those massive losses in years 1 and 2. You can't carry forward. My understanding is you can't carry forward those losses to reduce your tax liability in year 3, so you're screwed. So I just don't think that works anymore. And yeah, that's a really big problem for that type of gambling. Obviously, if you never have a losing year because you play high edge cash games, like you play like private cash games or something, or you play live cash games, or you play even if you play online cash games and you don't have losing years because you have a big enough edge, then that doesn't affect you at all, right? Like that second part doesn't affect you at all. But if you play like high variance tournaments and you do actually incur losing years, like then the second part is a really big problem for you, and you're probably gonna have to re-engineer how you run your gambling operation, like how you play, like manage your career as a professional gambler. And it's the same thing that would apply for sports betting. Again, I don't know. I don't think sports bettors like who are really good, I don't think they have losing years yet. I don't think there's enough volatility there. But if they do have losing years, then they would have to think about it there as well. So
maybe for daily fantasy, like because as I understand it, daily fantasy is like borderline tournament poker.
Okay.
So yeah, it's like high variance and whatnot. So
yeah, okay. Yeah. So like if you have any sort of gambling operation where it's multi-year in nature, and like you can lose in year 1 and year 2 and then win in year 3, but you win enough in year 3 to offset and more than compensate you for the time and everything in years 1 and 2. Like if you can't carry forward losses like that, that gambling operation's dead. Like again, that is just my understanding of the bill. If I'm wrong, I would love to be corrected, so you could just point me out to like why I'm wrong. And I like the education, so it's cool. And then I do want to like just finalize the things, I think, from my perspective at least, with the fact that like I think that as this legislation reads now, this is worse than Black Friday, because with Black Friday you could escape it by either going to Mexico or by VPNing from like I don't know Nebraska and pretending like you're in Mexico, and that was like a viable workaround. Whereas that you can't run away from like the U.S. tax code. Like for my understanding for U.S. citizens is that if they go to Mexico, they still owe tax to the U.S. government, right? And you still have to play by the U.S. tax code. So like if you go somewhere else, it doesn't matter. So you can't. My understanding is like this is not really legislation that can really be run away from. So this is like very impactful. I think that most people will probably ignore it. So I don't know what the short run implications are. But once like the understanding, like once people get some tax bills that they didn't expect, it'll have a really negative impact, I think, on. I think people will be slow to learn from this, but I think that'll have a really negative impact again once those tax bills come in. That their accountants are like, oh, it works like this. It's like, oh shit. Um, yeah, I think that at that point, there will be some pretty negative impacts on different types of gambling industries. And again, I'm not sure that how long it'll hold for, but yeah, it's pretty intimidating if you're a professional poker player. I'd say it's like you're gonna owe way more in tax. You're gonna owe way more in tax under like a lot of different assumptions.
Yeah. What do you think you would do if you were a professional poker player in the States and obviously let me make it a little more specific because I know this type of question you kind of want to at least have all the answers. But basically, let's say your EV roughly was in total income you're taking home at the end of the day before taxes. Let's say it's that 100K number. Let's say 100K. And you are so maybe if you're a cash game reg or a tournament reg, it's hard to quantify, but you have, let's say, a year's worth of savings. Maybe you got a family, maybe you don't. You can answer either way, but what do you think you would do in that situation if you were?
Yeah, I mean, like it's not like listen, it's really hard when you. So maybe you have a family, maybe you don't, right? Like there's a lot of that's like those are two like the flexibility of those two scenarios is like radically different.
I know. So maybe if you had a family, let's say you had a family.
Now
I'll
you're
make it more
screwed
difficult
though. Like
for
if you have a family, like you just like right, like
Yeah,
listen, if you have a
yeah.
family and you need the 100K, $100,000 income is, in my opinion, is difficult to replace, right? So
Mhm.
if you have a $40,000 income, which you didn't ask, but if you have a $40,000 income, I'd say quit gambling, go get a fucking job. You know what I mean?
Too easy. It's
Yeah,
not worth talking about.
too easy, right? Too easy.
Yeah,
So
yeah, yeah.
like, but that's what you do, right? Like in that situation, like you just, that's what you do. If you run a multi-year gambling operation, so that means that you are the type of gambler where you do actually lose from one year to the next. Like you can have losing years, and you're financially prepared for that. But you can have losing years. That just means you're a tournament poker player. Like, so it doesn't mean anything. It doesn't mean you're bad. Okay, just for everyone that's watching, like really good tournament poker players who have like really staggered buy-in schedules, they have losing years, like 100%, 100%. Okay, so and if you can have losing years, and then your plan is like use those losing years as offsets to like future gains, that doesn't work. So I would say like if that was me, I would legitimately re-engineer my entire gambling approach. I like if you have like a really high income, like that sucks. Like, but life's hard. I don't know what to tell you. But I would re-engineer. It doesn't mean you have to quit. It just means that I think the most, again, just my understanding. This is just my understanding. But I think the worst part of this legislation, as it reads, is that you can't carry forward a loss. I think that to me absolutely murders any form of gambling where that's a reasonably high probability. So I would re-engineer my schedule to like if you played big field MTTs, I would play smaller field MTTs. You know what I'm saying? If you played, you might have to like move down in limits. You know what I mean?
That's what I was gonna say. Yeah,
Yeah. Like to play games where you have a bigger edge, right? You move down limits, so you play games with a bigger edge. Like as you guys saw, like through some of the calculations that we made, like you can still make money and then have a tax bill that's like manageable. Like I didn't run through like a bunch of totally different, unrelated scenarios, like that are realistic for different people. I would do that if for myself. I would run through my own schedule and look at how many games I'm playing or how many bets I'm making. And I would run through my own like a bunch of iterations of like what's reasonable for me and like figure out what's possible, like what kind of income is actually like likely. You know what I mean? How much money do I need to make this work? Is it even possible? Like that brings everything into question. It doesn't make it impossible though. I think a lot of people are looking at this and they're saying like it's impossible to make an income if you have like this ROI, and it's like not really. It's just really hard to make a good income because we're going to take so much. But yeah, I would say that the main thing I would in the shoes of the people watching this, if they're professional gamblers or whatever, and that's how they make a living, I would start running some calculations. If I have a multi-year gambling operation, I would re-engineer it, and then rerun the calculations under the hypothetical scenarios that I've got, and see if I can make that work. Yeah, I mean, like that's like most of what I would do. Again, it's not. I don't want to say it's not financial advice. Like I know it sounds like advice, but it's gambling. You know, I'm a gambler. Like I know how this shit works. This is how I would do it. But that's not. I definitely don't think that I want to be like recommending, you know, in a strong way what other people should do. I am a degenerate loser who is often wrong. Okay, so don't trust me or anything I have to say. But
Yeah, I mean,
this is my opinion.
yeah, for what it's worth, I mean, you did give the one of the examples was, if you did um, have like a 200K a year, like you still take home 100K, so it's better than, going to get a entry level job somewhere else, which might be a little bit difficult when you tell them you're a professional poker player anyways for the last 10 years and you haven't worked a 9 to 5 and God
Yeah, I
knows
think
how
the
long.
example I
So,
gave was like if you had a 100K income, they would tax you as though you had a 200K income, and then
oh, sorry, I'm looking at it right now.
the
Yeah,
tax owed would be 50,000, right?
right, right.
And in that scenario, like you still made 50,000, which is like great. Like it's like it really like that's if you did that like that's great. Like it's a good accomplishment, but it's obviously half of what they're taking half your money, right? As opposed to 25% of your money, which is probably what
Mhm.
you're used to. But again, like if you go from having a 100K income pre-tax to having which is if you're paying your taxes, which is a 75K income after tax. Again, I'm just assuming a 25% tax rate. I know it's not. It doesn't. It's not just 25. I'm aware of that. Okay, I pay taxes. I know that. But I'm also not a fucking accountant, and we're doing the simple version. Okay, we're doing the dumbed down version for the dumb guy. Okay, so uh, you got a 100K pre-tax income. You're used to keeping 75,000 of that. They take 25. You're used to keeping 75,000, right? Now you're keeping 50,000. I mean, listen, there's worse things. You know what I'm saying? Like there are worse things than that. That's not like you died. You know what I mean? Like there's way worse things than that. It's not like your job's lost, right? Like you went from making 75K, it's a big pay cut. You lost a third of your take home, but you didn't lose all of it. You lost a third of it. So the tax bill doubled, but you still kept 2/3 of what you made. Or sorry, you still kept 2/3 of what you were keeping before. Um, so yeah, where before you would have kept. We all pay taxes. It wasn't like it's zero before this bill, right? So if you're again 100K taxable income, 25K in tax before this bill, 75K that you kept. Now you're going to keep 50. So 50 out of 75 is 60, 0.67, right? So you're keeping 2/3. Okay, so yeah, so like that's how it's like my understanding of it is it's not just a death sentence for everything, but it is sort of a death sentence for multi-year gambling operations where across multiple years you incur losses that are then subsequently encountering huge payoffs. And that again, like when I say that, I mean for people that don't gamble at all, like if this is the first time, like if you're not a professional gambler and you're like watching this video for the first time. I've worked with lots of professional, like I teach professional poker players how to get a little bit better. I help them with their strategies to make their strategies more effective. That's what I do. And I've worked with people who have had periods of time where they lost for 3 years consecutively. And then in year 4 made like, $400,000, $500,000, which if you take the net, that's like 100K a year. I mean, 4 years, like the losses were modest, right? Like the loss in year 1, 2, and 3, like there weren't massive losses, but they made more than enough in year 4 to justify the whole period, right? But that would be much more difficult to pull that off. It's a very painful thing for that individual to endure, and he did endure it. So kudos to you, Connor. Yeah, like that sort of gambling operation becomes much more untenable under this new tax regime, in my opinion.
Just sounds like same shit, different year. Poker just gets harder.
Yeah, it's a different way that it gets harder, though. This is a
Different way. Yeah,
Yeah.
I know. But no, that was great. You explained everything well. I think people should have a pretty clear idea of you know how this bill works, and obviously, this is just your opinion, right? I mean, I didn't really say much, so I'm not going to take credit for anything. If you guys want to blame anybody, blame Jordan. But yeah, we're not professionals. But I think everyone should have a better understanding now, and maybe an idea if you're a semi or full-time professional poker player, maybe you can check out stuff like actually Prime Dope is variance calculator, you could probably play around with it a little bit in terms of ROIs. Maybe just, get a little conservative on that end, and you'll get closer if you take out that, not necessarily 10%, but make your ROI a little bit less so you can kind of get to a number that is a little bit more realistic with this new bill coming through. But yeah, that's it.
Yeah,
Good
I
stuff,
mean,
Jordan.
yeah, just from my side, like this, I'm just a guy who's just like playing around with these numbers. Hopefully, you guys found it helpful as far as like how I break things down and how I try to think about it. Again, like I could have like a piece of missing information that leads to like different conclusions and stuff, and like that's sort of normal. Like if you're trying to do something, when like the information came out like today, basically, you know what I mean? Like the information came out today, or in like the last 24 hours, like the bill went through the House or whatever and got approved from that perspective on today. So like if you're like it's totally possible like I made a mistake, right? It's like totally possible I made a mistake, but this is how I would think about it. It's how I would break it down. It helps me to like stay rational to do things this way as opposed to like not seeing numbers, like just seeing it all fleshed out like really helps me to like get a good understanding of what's going on. And like I don't want you to feel like the sky is falling. Is this like is this a situation that's worse than it was before? If this is what you do, yeah, of course. Like in my opinion, yeah, it's worse than what you did before. Is it manageable? Yeah, it's manageable. Like for the most part, it's manageable. And yeah, like I said, I look forward to like the comments and seeing like seeing people correct me and tell me that I'm wrong and stuff. So that's it.
All right. Awesome. Thank you, Jordan.
Thank you. Cheers, bro. Bye.
All right. Bye bye.